My dividend growth portfolio is a real-life, real-time, real money demonstration of dividend growth investing. In a nutshell, here's what my portfolio is. It started in June 2008, which means that it just celebrated its 13th birthday. My dividend growth portfolio is officially a teenager. I started it with about $46,700 in 2008. Its current value is $160,000, which is a total growth of about 242% since I started it. Its primary goal is to generate income that grows steadily. The idea is that eventually the income from this portfolio can be used to supplement other sources of income in retirement. The dividend run rate from the portfolio has grown to $5,195 per year, which is an 11.1% yield on cost, YOC. What that means is $5,195 divided by the original amount that I invested, which was $46,700, comes out to 11.1%. Another way of looking at that yield on cost statistic is that the portfolio is now sending me in cash each year an amount that's the equivalent of 11.1% of the amount that I started the portfolio with 13 years ago. The portfolio grows organically. And what I mean by that is I have never invested another dime into the portfolio since I started it with that original $46,700. So all growth in total value, all growth in dividends received have come as a result of the portfolio itself, not as a result of me putting more money into it. That growth is fueled in a great part by dividend reinvestment, and I invest dividends monthly in the portfolio. In the middle of each month, I take the money that's been collected since the middle of the preceding month, pick out a stock or two, and reinvest it. Here is the portfolio. Don't try to absorb this information now because I'm going to put it back up on the screen at the end of the video, and you can pause it there and study it for as long as you want. I will just say that near the bottom of the portfolio where there are totals, everything that's covered in yellow represents a new high for the portfolio reached by June 1st of this year. It has a new high number of companies, 29. It has a new total value of $160,119. It has a new high in annual income rate of $5,195, and the yield on cost of 11.1% is also a new high. This is my favorite chart for the dividend growth portfolio because it shows the goal of the portfolio, which is steadily rising income, having been achieved straight along since the portfolio was started in 2008. In case you're wondering how fast that growth has been, as the bar for each chart goes higher each year, it's averaged 10.6% compound annual growth rate per year since the portfolio had its first full year in 2009. The red dots on the slide simply show the progress this year. So far, I've received $2,043 in dividends through the end of May, and that's shown both at the top center of the slide and by a red dot, if you can pick it out, on the 2021 bar, green bar. When I did my last portfolio update, I skipped over portfolio management because frankly the video was just getting too long. So this month I want to talk for a couple of minutes about how I manage this portfolio. First off, I will always preach about having a plan in investing. This portfolio has a formal business plan, and much of the plan is about managing the portfolio. How I pick stocks, how I reinvest the dividends, what's the maximum size for each position, how many stocks to own, what are the reasons to trim or sell a stock, and so on. Those are all topics covered in the written business plan for the portfolio. The reason that I emphasize investing according to a plan is because that brings out your best thinking. My plan has been developed over 13 years. You don't have to get it all right the first time you sit down to think about your goals, your objectives, how you want to invest, and what you want to accomplish. As you become a more experienced investor, it stands to reason that you'll become better at it. You'll have insights that you couldn't have when you first started, And so I keep running the plan. I generally formally update it and publish it around once a year, but I could do it 2 or 3 times a year. The value of it to me is that it then becomes a document that I can turn to when I need to make a decision in an ambiguous situation, or when the market is moving fast and there's a lot of noise, a lot of media coverage of fast price changes and so on. I can go to my written plan, look at it, calm myself down, and see what my best thinking on how to invest to reach my own objectives, what my best thinking has been and is to guide me through the current turbulence. Those of you who saw my recent video, the last video I did on AT&T, will recognize the truth of some of what I just said from that video. I repeatedly cited portions of my business plan for the portfolio and described how they helped me decide what to do in light of AT&T's surprise announcement about its restructuring. Let's focus on how I pick stocks for this portfolio. First, I apply a couple of dividend screens. The reason I do that first is because they're very easy to look up. And if a stock doesn't get by one of these initial screens, I can just discard it or set it aside, because I won't be interested in investing in the stock, even if it has a lot of other attractive qualities. Currently, I require, in order to make an initial investment, a 2.7% yield from the stock and a 5-year dividend growth streak. Any stock that hasn't compiled a 5-year dividend growth streak is not one that I want to make an initial investment in. I also check the DGR, which stands for dividend growth rate. I use a sliding scale such that if a stock is a high yielding stock, I will require less fast of a growth rate than I would for a lower yielding stock. But the lowest yielding stock, as it says on the first line there in the first column, is I won't invest in it if it yields less than 2.7%. Moving across the table, the second column, company quality, you're probably familiar by now with my quality snapshots, which is a pretty quick method to judge company quality. And sometimes I do deep analyses that involve getting into the company's business model, its financials, its balance sheet, meaning its debt, and things like that, to get a really good idea of how good and how high quality a company it is that I'm looking at. Assuming a stock passes all of those hurdles, then I do a valuation of it. I require the price to be at least fair for the stock's performance and its earnings and so on, and preferably I look for a discount. And even in a market that's generally considered to be overvalued, as the current market is, it's surprising how often high quality companies that meet all the requirements that you might want, or that I might want for my dividend growth portfolio, are selling at fair prices. It happens all the time. Finally, I look at portfolio fit. I want a well-rounded portfolio. I may be building a position, which means that I might give a tie break to a company I already hold versus a company that I don't already hold if my current holding is small and I would like to see that position get bigger in proportion to the size of the whole portfolio. Finally, in the right-hand column, there are a couple of things I don't care about that some investors do, so I thought I'd mention them. Number one, I don't care when I buy a stock. Since I'm surveying the landscape all the time for investable stocks, I don't do what some investors do, which is focus on 1 or 2 stocks and say, okay, now I'm going to spend the next 6 months, or now I'm going to spend this year building that position up. I don't approach things that way. I may have started a position when the stock was well valued. The next time I have money to invest, its price may have shot up, meaning it's not well valued anymore. And in that case, I won't doggedly say, well, I'm going to buy it anyway because that's my mission this year, to build up this position. I'll turn my attention elsewhere and find a different stock that also meets my requirements that I can get at a better value, which always coincides with getting it at a higher yield. As a result, I also don't care whether the positions in my portfolio are unbalanced. So I may have, I have a maximum position size of 8%. of the portfolio. I have some positions that are 1%, 2%. I don't think in terms of full position or half position or oversized position still being acceptable. I have a straightforward cap. No position should be higher than this because I want some diversification in the portfolio. But underneath that upper level, I don't care how big the different positions are. By going back and forth over time, looking for good valuations and high quality stocks, I know that I'll fill out the smaller positions over time. I don't feel the need to do it all at once. Now, I should say that the way I approach investing, especially with the dividend minimums, the dividend growth requirements, and the high quality requirements, I exclude some great companies. For example, my rules would exclude a new purchase of Apple right now. Even though Apple is one of the highest quality companies on the planet, as shown by this quality snapshot, where Apple gets a total of 24 out of a possible 25 points, I wouldn't buy it right now. And the next slide shows a couple reasons why. This price graph, which is from Fast Graphs, shows a couple of the reasons why I wouldn't buy Apple now. Number one, look at the green arrow pointing up in the middle of the price chart. The two colored lines, the magenta line and the blue line, are fair value reference lines. And you can see that Apple's price, which is shown by the black line, is way above fair value at this time. Apple's simply too far overvalued, and I wouldn't buy it for that reason alone. But there's a second reason. Over in the right-hand column, the dividend yield of Apple right now is 0.7%. And as I said before, my requirement for buying a new stock is that it has a yield of at least 2.7%. So Apple, as good a company as it is, falls well short on a couple of basic selection principles that I follow. In contrast to Apple, let's look at a far less famous stock that does fit my criteria. Pinnacle West is a utility based in Arizona. Many of you have probably never heard of it. But in fact, if you look across at the quality snapshot, you see that it scores in the green scores on every category and gets a total score of 22 out of 25 points, which I consider to be above average. And Pinnacle West's price chart shows much different stats than the Apple price chart did. For one thing, you can see that Pinnacle West's price is a little bit below the fair value reference lines on the price graph. And over in the right-hand column, we see that Pinnacle West is yielding 3.9%. That's well above my minimum requirement of 2.7%. And so Pinnacle West, which I already own some of, would be and is a candidate to add more shares to when I get dividends to reinvest or when I get other money from another source. By the way, I just want to add here that I do own Apple. It's hard to remember now, perhaps, or if you're a younger investor, you may not have realized. It's not that many years ago that Apple was a dividend growth stock selling at an absurdly low valuation for what it became, and selling for a qualifying yield. And so I bought shares in Apple several times about 5-6 years ago now, I think it is, and they've done fine. Want to remind you that the yield of a company runs inversely to its price. So as Apple's price has shot way up, which we saw in a previous slide, that's why its yield has slid all the way under 1%. It wasn't always that way. And that's how I pick stocks. The most important takeaway for your own investing is that I believe in having well thought out guidelines, following them, and trusting the process. That's the best way that I know to protect you from yourself. And by that, I mean keeping away from bad habits like mission creep, making impulsive decisions, and being influenced by noise from TV, articles, and videos, including perhaps this video, that don't speak directly to what it is that you are trying to accomplish with your investing. Before I keep my promise and put the portfolio back onto the screen, here's a summary of what happened in the portfolio since my last update. This slide shows you what happened in the past month since I last updated the video, just to keep you abreast of the ongoing progress in the portfolio and give those of you who are perhaps less experienced investors a sense of what it's like to run an active portfolio. First of all, as I mentioned earlier, the portfolio celebrated its 13th birthday. It was born on June 1st, 2008, and it is now past June 1st, 2021. The dividend run rate advanced to a new record of $5,195 per year. The yield on cost advanced to a new record of 11.1%. The total return advanced to a new record high of $160,119. That's a total increase of 242% since the portfolio was begun in 2008. And finally, I reinvested dividends last month, and in doing that, I added 1 share of LMT, which is Lockheed Martin, and 2 shares of MRK, which is Merck, the drug company, and that opened a new position in the portfolio. Okay, that concludes this month's report on my dividend growth portfolio. Now I will put the full portfolio back on the screen. You can pause the video to study it as long as you want, and I'll be glad to answer your questions in the comments section. Thanks for watching. Bye, everybody.